Hi, and welcome to this week's episode of the Cost of Carry podcast. My name is James Chi. Let's get started. Should you consider a construction loan? Over the past 12 months, homebuyers have been given a host of government incentives to enter the property market, and a large portion of them are centered around building your own home. Both the federal government and various state governments have launched various stimulus packages on the back of COVID-19. The measures were meant to boost the building industry, and it has led to a boom for owners of vacant land in many states. According to the ABS, construction for new dwellings spiked by 11.5% in October 2020, and in conjunction with record low interest rates, has been a major factor in confidence quickly returning to the housing market. With the government launching Home Builder in particular, many home buyers have clearly chosen to build, and that has forced them to get a construction loan. So how does a construction loan work? Construction loans are put in place to help with the funding of the building of a new home or undertaking a substantial renovation. The actual process differs slightly to a traditional loan, as well as the assessment of the loan application. Because the home is not yet built, valuers will be required to estimate what a fully finished home might be worth. At the same time, given the shorter time frame associated with building compared to a more traditional 30-year mortgage, the interest rates attached to a construction loan are going to be slightly higher. A construction loan also differs from a traditional loan in that it is normally only an interest-only loan for the period that the home is being built. Notably, this is broken down into what is known as progress payments as the construction loan moves forward, and is based on a number of different stages of the build. The first stage. This is known as the slab down or base, which covers the costs of laying the home's foundations. The second stage. After the foundations are in place, the frame is assembled, and this stage is therefore known as the frame stage. This is what also includes roofing and brickwork. Stage 3. Lockup, and this occurs when the house can be physically locked. This means it is finished with the external walls and has windows and doors in place. The fourth stage, the fit-out stage, and this is when the internals of the house are undertaken. This includes cupboards, shelvings, tiling, and flooring, as well as plumbing and electrical work. And lastly, the fifth stage, the practical completion, which occurs when all the finishing touches are done, which includes painting, carpeting, installing fences, gardens, and giving the property a final clean. At the completion of the property, a construction loan will generally revert to a standard principal and interest loan, or the homeowner will likely refinance to a loan product that suits their needs. As mentioned, interest is charged only on the total amount of money that is being drawn down based on the various stages of the construction. While many of the government programs are now coming to an end, and some have already come to an end, many first home buyer grants are available for those looking to build, so it's important to understand how construction finance works. And that concludes this episode of the Cost of Carry podcast. Thank you all for tuning in, and I'll see you in the next episode.